Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the PIMCO GIS Income Fund. The PIMCO Income Strategy was incepted in 2007 and was popularized in the next few years after the 2008 financial crisis by taking a differentiated view and overweighted in the then cheap but unloved US mortgage-backed securities, and thereafter outperforming most peers when the MBS market rebounded. This offered a different approach to income investing that deviated from the traditional government and corporate bonds, and instead diversified into securitized assets and more complex credit structures to find opportunistic income sources. The lead manager of the strategy, Daniel J. Iverson, caught fame for his investment acumen and rose through the ranks in the firm. Today, Iverson has become PIMCO's group CIO, and the PIMCO Income Strategy has evolved into PIMCO's flagship solution by gathering some of the best fixed income investment ideas from different teams in the firm into a portfolio of stable returns and income with prudent handling of risk management. With a strong long-term performance track record and a consistent income distribution, the PIMCO Income Strategy has gathered significant client interest globally throughout the years. The PIMCO Income Strategy is currently the largest actively managed bond fund in the world, leading by a wide margin with nearly $180 billion of AUM in the US vehicle and over $93 billion of AUM in the international vehicle. The success of the PIMCO Income Strategy has obviously led to many other fund providers attempting to challenge the throne with their own solutions. However, none has managed to topple the crown over the years. The PIMCO Income Strategy remains on the product offering list from most distributors today as one of the most popular mutual fund solutions for investors of all types. With that, let's dive in to understand more about the fund. The Pacific Investment Management Company, or better known as PIMCO, was founded in 1971 and has over the years established itself as a leading global asset management firm in active fixed income investing, with deep expertise across public and private markets. PIMCO today manages nearly $2 trillion worth of assets from investors of all segments, supported by over 3,000 employees based in 23 offices globally. PIMCO offers a wide variety of fixed income managed products, with income-focused strategies being its specialty. PIMCO serves clients globally across the full spectrum, from central banks and sovereign wealth, to pension and endowment, to family offices, to private and retail investors. PIMCO puts quite a bit of effort into understanding global macroeconomic and geopolitical changes in order to ensure their funds steer toward the right directions. This is helped by their Global Advisory Board, formed by ex-central bankers and ex-key government officials, who can help guide the firm in this aspect. The Global Advisory Board members are updated periodically. Ben Bernanke, ex-US Federal Reserve Chairman, and Ng Kok Siong, ex-CIO of Singapore's GIC and presidential candidate in 2023, used to be in this board as well. Through the years, PIMCO has built a strong reputation and branding of having generally good performing solutions. PIMCO was acquired by Allianz SE in the year 2000 but runs as an autonomous subsidiary. Therefore, its product offerings are independent from other asset management businesses of Allianz. The PIMCO GIS Income Fund is the international version of the PIMCO Income Strategy, intended for investors outside of the US. It is a sub-fund under the PIMCO Fund's Global Investors Series PLC fund family, or in short, PIMCO GIS. PIMCO GIS is set up as an umbrella-type open-ended investment company with variable capital structure in Ireland, which is commonly referred as OEIC or ICVC. PIMCO GIS is UCITS qualified, and covers a broad list of mutual funds intended for international investors outside of US. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. There are a few versions of the fund objective as per stated in the website and various fund documents, but the version in the prospectus is the most comprehensive, and so I will refer to that. The primary objective of the fund is to seek high current income consistent with prudent investment management. The secondary objective is long-term capital appreciation. It is important to understand the way bond funds work is different from single bonds. For PIMCO GIS Income Fund, the main objective is to create and maintain a portfolio that can generate and distribute income that is considered high enough for the current market environment. There will be often times when the underlying coupon yield is insufficient and capital gains is used to contribute to the income requirement. There will also be times when the market is bad and the fund will still maintain the high income and therefore lose some capital. Prudent risk management is key in managing this primary objective by minimizing drawdowns through understanding the risks taken in the positions and as well avoid excessive risk taken just to boost the income. Capital appreciation as a secondary objective means it is a nice to have, and the fund is more likely to maintain a total return performance that is just sufficient to generate the income requirement, and occasionally add a small amount of capital appreciation return. The fund runs a global unconstrained strategy that allows it to invest across regions, industries, issuers, and asset classes within the bond universe. The paragraphs here elaborate on this and clearly specifies that it can invest in all types of bonds, from sovereigns to investment grade and high-yield corporates, to securitized assets to emerging market bonds, and as well take foreign currency exposures. The next few paragraphs further elaborate on this and provides specific constraints, such as maximum 50% in non-investment grade credit rating, maximum 20% in emerging markets, maximum 100% in US government guaranteed securities that refer to US Treasuries and agency MBS, and maximum 30% non-US dollar currency exposure. Furthermore, a long paragraph that states more specific constraints, including maximum 25% in convertible bonds, maximum 10% in direct equity stocks, maximum 10% in other funds, and maximum 10% in insurance-linked products such as catastrophic bonds. There is also a paragraph stating that the fund can use derivative instruments. For equity funds, derivatives are normally used only for hedging purposes and efficient portfolio management. For bond funds, derivatives are commonly used for investment purposes, especially to express interest rate and duration views, or to take indirect bond exposures such as credit default swaps. Last but not least, there is a paragraph stating that the benchmark of the fund is Bloomberg US Aggregate Index. By using the US version instead of the global version of the Bloomberg Aggregate Index, we can infer that the fund will take a natural US bias in its exposures. This is likely because the team is US based and has the most expertise in the US bond markets, and also that the US has the largest bond market in the world and is most applicable for US dollar-based portfolios. It is important to note that the prospectus clearly states the benchmark is not used to define the portfolio composition or to provide a performance target. So that means the fund can have a very different exposure, and outperforming the benchmark's performance is not an objective. Let's see how all this translates into the actual fund portfolio. The PIMCO GIS Income Fund aims to achieve its objectives through a barbell approach by having a portfolio mix of high-yielding positions that is balanced off with high-quality positions. This is most clearly observed from the fund's market value breakdown, which interestingly is not available in the fact sheet, but is present in a separate document called Sector Allocation Chart. PIMCO uses gross market value reporting, which is elaborated in fine prints, but no need for us to run through the nitty-gritty here. What we can see in this pie chart is that PIMCO has nicely split the sections into different color coding. The blue ones comprise about half the portfolio and refer to the high-quality, safer positions that include government bonds and agency MBS that is government guaranteed. The green and red ones are the other half of the portfolio that are higher yielding and the main source of income, with the green ones being less risky, such as investment grade credits, and the red ones are the riskier ones, such as high yield bonds and emerging market debt. Given the barbell approach and the high allocations in government bonds and agency MBS, the portfolio is able to achieve a high AA- average credit quality. At the same time, the same barbell approach is still able to generate a decently high estimated gross yield to maturity of 6.98% to cater for the primary objective, that is income generation. It can also be seen in this pie chart that securitized assets occupy a significant half of the portfolio. While this highlights the core expertise of the managers in this asset class, it is also a reflection of PIMCO's views of the current market and their assessment that securitized assets, in particular agency MBS, is currently a superior segment within the bond universe in terms of income generation from a risk-adjusted basis. Browsing through the fund commentaries further substantiate this point, as the team has been and continues to maintain an overweight view in US agency MBS. The fund strategy already indicated this is a US bias portfolio. On actual implementation, US is 87% on duration-weighted exposure basis, and US dollars exposure is 97% of the portfolio. Again, while the fund runs a global unconstrained mandate, the reality is that this has always been and still is a very US and US dollar-centric fund, as a result of PIMCO's expertise and assessment of the global markets. There is nothing wrong with this, though investors who prefer to have less US exposures may need to consider other alternatives. Yield curve positioning and duration management are key areas in the risk management of the fund. The fund has been maintaining intermediate maturities around the 5 years as the sweet spot and slowly adding towards 10 years for some time now, while diversifying interest rate duration from US to UK and Australia. Historically, the fund has exhibited its ability to adjust duration exposure quickly and sharply to tackle changes in the interest rate environment. The fund currently has an effective maturity of 5.71 years and effective duration of 3.99 years. The negative exposures here shows the fund actively uses derivatives to express specific market views, such as underweighting the very short end and very long end of the yield curve. While it is not indicated in the fact sheet, the prospectus does state the average level of gross notional exposure for the fund is at about 340%, suggesting the fund does have quite a bit of leveraging in the portfolio. There are also other details available in the fund webpage, such as industry sector breakdown and bond sector allocation by duration. However, the portfolio only has a relatively small exposure in corporate credits, so industry sector isn't too useful. And the sector allocation by duration serves mainly to further complement the duration breakdown. The fact sheet does have a top 10 holdings, however, it is firstly outdated, and secondly doesn't really tell much, with US Treasuries and agency MBS taking the bulk of the list. For investors who like to dig deeper, the fund actually provides a full list of holdings in a CSV file based on last quarterly unaudited positions. In it, you will find thousands of line items, including details of all the bonds in the portfolio, and as well all the derivative swaps and FX contracts. The PIMCO GIS Income Fund is co-managed by 3 high-profile managers in the firm. Daniel Iverson and Alfred Murata are the original co-managers of the PIMCO Income Strategy since inception in 2007. Iverson climbed up the ranks in the firm quickly after the success of the PIMCO Income Strategy and is now the Group CIO of the firm. He remains heavily involved in managing several funds and obviously including this fund as well, given the PIMCO Income Strategy has been elevated to flagship product status and receives the best income ideas from the different teams in the firm. Murata, on the other hand, remains focused on investments rather than management roles. He covers multiple product strategies in the firm, including income-oriented, multi-sector credit, opportunistic, and securitized strategies. Joshua Anderson joined the co-management of the fund in 2018. which I suppose is to help relieve some responsibilities from Iverson and as well to provide a third-person view to the handling of the flagship product. Anderson also leads the global ABS portfolio management team in the firm. Browsing through the bios of the three managers, it is easy to identify their commonality in their expertise for securitized assets. It is therefore expected that securitized assets will remain a sizable allocation in this fund. Let's take a look at the fund performance using the retail E-share class as an example. The performance data provided in the fund fact sheet is quite detailed, which includes annualized returns across multiple time periods and 10 calendar years of returns. We should firstly ignore all the lines that says net of 5% preliminary charge, because if you are getting charged anything more than 1% subscription fee for bond funds, you should really change the distributor bank or platform. The next thing to note is that the fact sheet provides data for both accumulation and distribution share classes. There will be very small differences in the performances as there is a bit of transaction delay in reinvesting the distribution payouts for the distribution share class to derive the total return data. For purposes of analysis, we will refer to the accumulation share class. Looking at annualized returns, we can see that the fund has managed to outperform the benchmark across all time periods from 3 months onwards. On 10-year basis, the fund returned 3.46% per annum, which is nearly 2% better than the benchmark. On calendar year basis, the fund outperformed the benchmark 7 out of 10 years. The 2 years of negative returns were in 2018 and 2022, both during interest rate hiking periods. It is useful to note that the few years following each negative calendar year had delivered decent returns. However, remember that the benchmark only serves as a reference and the fund has a rather different composition compared to the benchmark. So let's compare the fund performance against other peers to see whether the PIMCO GIS Income Fund deserves to be at the top in the category. Let's start off with passive ETFs and see how PIMCO GIS Income Fund compares against them. Using the total return charts from Morningstar, I have included SHY and TLT representing short-term and long-term US Treasury bonds, LQD representing the US investment-grade credits, HYG representing US high-yield bonds, IAGG representing non-US credits, MBB representing US MBS, and EMB representing emerging market bonds. This will cover majority of the bond markets and as well the main exposures of the fund. In this 10-year chart, the PIMCO GIS Income Fund has delivered 40.87%, significantly outperforming the ETFs with the exception of HYG. It is useful to note that the fund's performance line is most similar to HYG, but with less volatility. This accurately reflects the fund's objective to deliver high income, but with a more stable experience through prudent risk management. It is also interesting to note that Treasury bonds, despite being perceived as low-risk sovereign-issued products, has exhibited very high volatility, especially with the long-term TLT, suggesting that active interest rate management is crucial for bond funds. Also worthwhile to note is that while retail investors can access the US MBS market through MBB, the performance experience is visibly subpar compared to the fund, which has a high overweight in the same asset class. So again, having an active manager to research and filter the market for better investment ideas works in bond markets. Shifting to a shorter 5-year period, the same is observed, with PIMCO GIS Income Fund delivering 22.56% and again better than the ETFs except for HYG. HYG has positive correlations with equity markets, hence the returns have been strong with the bull market during this period. In contrast, LQD, MBB, IAGG and SHY were pretty much flat for the 5-year period. Lastly, for a very shorter 1-year period, PIMCO GIS Income Fund delivered 6.89%, trailing behind HYG and EMB. 6.89% is still a very decent 1-year return, and again, a key observation in this chart is that the fund has maintained a significantly more stable journey compared to most other lines in the chart that has exhibited bouts of volatility. Should we just invest in HYG instead, since it appears to perform better than PIMCO GIS Income Fund? Not really. If we stretch the time period longer to late 2012, when this fund share class was incepted, we can see that HYG has had a much more volatile journey, and the total return is actually just slightly lagging behind the fund. HYG may have a slightly better performance in recent years. However, if the fund can offer a lower likelihood of drawdowns, it can and has proven to deliver a similar long-term return and lets you sleep better at night. So in view of this, I think PIMCO GIS Income Fund is a superior investment compared to passive ETFs. Next, let's compare PIMCO GIS Income Fund against some of the popular income bond fund solutions from its peers. I have included here M&G Optimal Income, JP Morgan Income, Jupiter Dynamic Bond, AB American Income, BlackRock Fixed Income Global Opportunities, Capital Group Global High Income Opportunities, and Neuberger Berman Strategic Income. 8 funds is the max I can include in the Morningstar chart, so I may have missed out some other funds out there. Though, these 7 are certainly well recognized in the industry as competitors attempting to dethrone PIMCO GIS Income Fund. The share classes I've used here are all retail US dollar share classes. Starting off again with a 10-year chart, PIMCO with its 40.87% return outperformed all 7 other funds, with JP Morgan and Capital Group trailing slightly and the rest quite a gap away. It is also visible in the chart that PIMCO has had a relatively more stable journey and lesser drawdowns in most instances despite having the best return. Shifting to a shorter 5-year chart, we can see that PIMCO now has some fierce competition, with Neuberger Berman and Capital Group outperforming slightly and M&G nearly identical in returns. These 3 funds have had a slightly higher volatility, especially seen during the earlier 3 years. Lastly, for a very short 1-year period, PIMCO trails behind Neuberger Berman but outperformed the rest. We can therefore see from these charts that while PIMCO GIS Income Fund has not always been the leader across different time periods, it has been very consistently at the front group of the pack, and this has led to the fund being the top on a 10-year basis. So in view of this, I think PIMCO GIS Income Fund remains a strong pick among active mutual funds as well, deserving its crown as the most popular active bond fund in the market. Given the PIMCO GIS Income Fund is a favorite across all client segments, the fund has a variety of client-type share classes available. In terms of descending TER, the most common is the Retail E-share class, followed by Administrative class, then Investor class, and finally Institutional class. The TER range is big, from 1.45% of E-class down to 0.55% of Insti class. This means, as an investor, if you are able to subscribe to the Insti class instead of the E class, your investment returns is 0.9% higher every year. For a fund that delivers on average mid-single-digit returns, this is a significant amount. Distributors obviously potentially earn the TER difference as trailer fees, so most of the distributors tend to offer the Retail E class or at best the Admin class. There are, however, some distributors that offer Insti class, so it is in your own best interest to find them. Here is the Morningstar total return chart again to show how much difference the returns have been comparing the E-class versus Insti class since fund inception in 2012. Given the fund is based in US dollars, these different client type share classes also offer both accumulation and distribution version for US dollar share classes. Distribution classes are all monthly payout frequency to provide a stable income stream for investors. For Sing Dollar investors, the fund also offers Sing Dollar hedge share classes for all client types. Sing Dollar hedging costs do vary over time, averaging about 0.7% per annum in the past 10 years. Last 1 year, the Sing Dollar hedging cost was high at about 1.8%. When hedging cost is high, it is possible that going for a natural Sing dollar bond fund instead can give similar or even better returns. Other currency classes available include Euro, Sterling, Swiss franc, Japanese yen, Aussie dollar, CNH, and Hong Kong dollars, and more, with most of them being currency hedge share classes. Finally, let's take a look at the distribution policy of the fund, which is an important aspect, as many investors use this fund to generate their income stream. The fund webpage provides a series of different yield information, but to keep it simple for retail investors, I suggest to focus on just the annualized distribution yield and the dividend distribution amount. Using the e-distribution US dollar class as an example, the annualized distribution yield is currently 6.22%, which reflects the historical payout yield that investors have received in the past 1 year. This is also the yield number that is commonly used to compare against the distribution yields of other bond funds. The dividend distribution amount is the actual dollar value that is being paid out per share, so that as an investor, you can calculate the exact amount that you would receive in each distribution based on the number of shares you have in the fund. PIMCO is extremely transparent with its distributions, and the full history can be downloaded from the fund webpage. Also very important to note is that PIMCO has clearly indicated that the distributions are partly from organic income and partly from capital. Again, reflecting that income generation is the primary objective and capital appreciation is secondary. Now, if you download the distribution history, you will find that the fund originally had a distribution amount of $0.0366 per share, which calculated to about 4% yield. The only period that this was adjusted was around Q3 2022, in the midst of aggressive interest rate hikes, to $0.0496 per share, which calculated to about 6% yield, and stayed the same till now. While this shows the fund is careful not to make frequent adjustments to its distribution policy, investors should expect the fund to eventually make adjustments again if interest rates move down substantially, because that would make the 6% yield unsustainable. This brings us to the next question. What is really sustainable? If we bring back the performance data again, we can see that the fund delivered 4.28% per annum total return since inception. While the 5 and 10-year returns are lower, mainly dragged down by 2022, which was a very bad year for bonds, it does suggest that the original 4% yield set by the fund looks to be quite sustainable in the long run. Adjusting the yield to 6% in 2022 appeared to work in 2023, but not for 2024 without sacrificing some capital. So we may see the fund adjusting the yield back down to the 4% level in the future. I would also like to take this example to stress that looking at total return is much more important than looking at yield numbers for bond funds. Some other bond funds may be marketing a higher yield than the PIMCO GIS Income Fund, but if the total return is worse off, it simply means that it is a worse deal for investors. And the final question is, what is really the impact of the distribution policy to the capital or the NAV of the fund? For this, we refer to the NAV chart from Financial Times website. The e-distribution US dollar class was incepted with an NAV of $10. There was a small capital appreciation phase, and the fund thereafter maintained its NAV at around $10.50 to $11 levels, while keeping the payout yield at 4%. This suggests that 4% yield was optimal and sustainable for the fund without sacrificing NAV in the long run. Things changed from late 2021 till end 2022 when there was a sharp interest rate hike period. This resulted in a permanent NAV loss, and the fund was forced to shift the sustainable NAV level down to around $9.50. At the same time, the bond markets adjusted to the higher interest rates and gave better yields, leading to the fund having to adjust its yield to 6% to match the market conditions. Now, the fund could have kept the yield at 4% and used that 2% difference to recover back the NAV, but this is not the intent of the fund, as income takes a higher priority than capital appreciation for its objectives. This is important for investors to understand, as this is the strategy and objective of the fund, which give a very different experience compared to investing in direct bonds. With that, let's summarize our findings. PIMCO holds a high reputation as a global leading active manager in fixed income solutions. The PIMCO GIS Income Fund is PIMCO's flagship product and managed by its group CIO, which means there are high stakes in the firm to ensure the success of the product. For a popular retail product, the fund's barbell concept of balancing high yielding versus high quality exposures to achieve a stable return with high income is easy to understand for retail investors. However, the actual strategy and implementation of the fund is highly complex, with exposures to asset classes such as securitized assets that may require advanced knowledge to appreciate the risk and reward considerations, and also significant usage of derivatives and very active management on duration, maturity, and FX positioning. While the fund's mandate is global, the actual portfolio is significantly overweight in US. There is nothing wrong with this, as the fund manager may identify the US bond markets having more opportunities, but investors who are looking to diversify beyond US will need to consider this aspect. The fund has a strong long-term performance track record, exhibiting a superior risk-adjusted return compared to both passive ETFs and other active bond funds. The fund has a wide range of share classes for different client types and currency requirements. Given this is a popular fund, it can be found in most distributors' offerings. Retail investors can try to find a distributor that offers lower TER share classes of the fund to achieve better returns. The fund currently has a distribution payout yield at around 6%, which is attractive in current market conditions. However, with interest rates declining, the fund may eventually have to adjust down the yield back to the original 4% levels. Lastly, I would like to stress again that the primary objective of the fund is to provide high income with prudent risk management. Capital appreciation is secondary, and as elaborated earlier, the fund hardly has any NAV growth. Investors need to be clear that this is what they are looking for. Everything considered, I think the PIMCO GIS Income Fund well deserves its crown as the most popular active bond fund in the industry. The consistency of its performance over time has helped the fund fend off competitors trying to replicate its success and take over the throne. Even with its staggering AUM, the fund remains a top pick as a core bond fund position in investors' portfolios. This concludes my absolutely biased comments on the PIMCO GIS Income Fund. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.